I think what stands out to me is a sort of a playbook that's very similar to the playbook we saw in the UK in the run-up to 07-09. And that playbook is, as is well described and well known down here, is a very strong housing market in the run-up to the last 12 months or so ago. A household that stopped saving with a savings ratio that's super low. It's been a bit lower, but it's super low. And a lot of debt that's been built into the system and that's generated high house prices. And I think then you get into the pro-cyclicality of the downturn. And this is the bit I think people never fully quite get the full grip on until it's actually playing out. And it seems it takes a load of chapters to get there. And I thought that, after the recent housing finance data, I noticed there were some more domestic houses that downgraded their outlook for house prices. It's a slow sort of process, but actually the reality is banks are pro-cyclical. They're pro-cyclical on the upside and on the downside. And of course what happens is once house prices start softening, a few quarters after, household savings ratios start going up, households start panicking, confidence comes off. And that's what generates the recession, really. And I think that's the playbook that we'll probably see down in Australia that'll get the recession going. And interesting, if you look at all the parallels of developed market housing deflations, really once you get 8–10% off the peak of house prices, you're looking at a household savings ratio that's going to go up 2, 4, 5, 6, 7, 8, 9 percentage points. And those are big moves. They create recessions. It's a very difficult time in markets, and I would actually say, I speak to a lot of people in various financial centres around the world, and I'd say there's a lot of 50-50 out there. So I can see a really strong argument for being reasonably optimistic about the global economy on a 2-year view, but I can also see some very, very serious risks. And if you think about it, we've tightened money a lot. That doesn't tend to happen except at the end of cycles. So I actually want to hedge my bets a little bit. I have views and we express views obviously, but in terms of a 1 to 10, I would be a complete hedge in the middle, because I can see a good 2 years, but I can also see that tightening in there. And actually, it's like someone said the other day, this probably works well in Australia. When you fish with dynamite, it takes a while for the big fish to come to the surface. And that's really what tightening is. It's a very blunt tool. It's a bit like fishing with dynamite. And sometimes things come to the surface, you don't realize it for a while. So I guess I'm saying I'm a 5, which is a complete fudge. In Australia, I'd be much closer to a 10 on bearish, because I think there's a very real risk that things really have rolled here, and you'll see the pressure come to bear over the next 12–18 months.